Hello, my name is Ray Bowman. I spent over 30 years being involved in international trade and logistics. I'm a certified global business professional. I'm the director of the Small Business Development Center for the EDC. We're part of a nationwide network supported by the Small Business Administration of the U.S. to provide business consulting services for small and medium-sized companies. I'm also a program chair for the Southern California District Export Council. We're a group of volunteers appointed by the U.S. Secretary of Commerce to promote U.S. exports. I also belong to several trade organizations, as well as a professor at California Lutheran University, as well as Santa Barbara City College. Both institutions provide training and instruction in international business and logistics. So what I'm going to go over today is best practices in trade finance. So there's a lot of different best practices. I want to go over some of them. These are some of the things that I've learned in my career, and hopefully they'll be helpful for you. The first best practice I want to go over is credit insurance. So there's domestic credit insurance and there's also international credit insurance. So a lot of these techniques can be used both domestically and internationally. So I like to mention that as to make sure that you're taking full advantage of both of these best practices, domestic and otherwise. So credit insurance. Credit insurance covers the risk resulting from the delivery of goods or services. Purchased by business entities to insure their accounts receivable from loss due to insolvency or debt or debtors. Agreed percentage of an invoice or receivable that remains unpaid as a result of unprotected default, insolvency, or bankruptcy. And the costs are usually charged monthly and are calculated as a percentage of sales of that month of all outstanding receivables. So basically, the way this works is you purchase credit insurance, and the credit insurance company will look at the various companies you have domestic and internationally and run credit checks on them. At that point, they will determine what the risk and the premium and deductible that you're going to pay on this insurance policy. So the way it works functionally is, let's say that you get extended terms to a company, let's say in the UK. You've extended terms to the UK of this company for, let's say, 30 days. Let's say 30 days comes and goes and they haven't paid you. You've sent out demand letters, you've talked to them, they've accepted the product, there's been no issue with product defects or the color, there's no real trade dispute, which is an important part because credit insurance will only pay if it's not disputed. But let's say they haven't disputed, they haven't paid, and now all of a sudden 90 days rolls around, they still haven't paid. At that point, in that country where it becomes a bad debt, you can file a claim on that particular receivable. At that point, the credit insurance company will process the claim, pay you, and essentially purchase that bad debt and go after that bad debt to recover what they forwarded to you. So it basically works a lot like, if you're familiar with car insurance, it's very similar. There's a deductible, there's a risk rating that's given, and in the event that that non-payment happens, just like in the event you may have a car accident, then that's the point at which it pays. Credit insurance is a great way of reducing the risk of open account exposure. Also, too, if you're going to give open accounts, the other advantage with export credit insurance is not only reducing your risk, but increasing sales. In other words, if an international buyer is asking you to extend terms, you're basically becoming a bank or a lender for that firm or for that buyer. So if they're going to ask that of you, then it's perfectly reasonable to add on a certain amount to take on that risk. So a good way of running export credit insurance is knowing how much you're going to spend on that credit insurance and building that in to that transaction so you recover that amount. At the same time, if an overseas buyer is going to ask you for terms, then it's reasonable for you to ask for more sales activity, either a commitment of sales or an increase in sales to justify taking the risk of open accounts. So a lot of international importers and exporters will use credit insurance in different ways to increase sales volume, or increase the length of a commitment to buy. So very good best practices. There's a lot of various companies that you can look up that provide this type of insurance. If you're a U.S. company with a U.S. origin product, then the Import-Export Bank of the U.S. or Exim Bank can provide very good rates to those types of companies. Next best practice is a standby letter of credit. So there's really two types of letters of credit that we think about internationally. One is what we call a documentary letter of credit. It's basically a letter of credit where the buyer sends a set of instructions on documents that must be submitted in order to collect a guarantee of payment by their bank. So it's essentially the buyer substituting their credit for that of their bank, which will pay based on the submittal of documents that are required. Another type of letter of credit is this, a standby letter of credit. So essentially, a standby letter of credit is issued by a bank on behalf of a client that is used as payment of last resort. In other words, collateral that's put up, should the client fail to fulfill a contractual commitment with the third party, as a sign of good faith and a proof of the buyer's credit quality of repayments. The bank issuing the standby letter of credit will ensure the credit quality of the party seeking the standby letter of credit, then send the notification to the bank of the party requesting that letter of credit. So it's basically using a bank, using a standby as a form of collateral. That collateral will sit out there in reserve to help ensure performance, either performance of a buyer to pay or performance of a seller to fulfill a contract. So standby letters of credit are actually more commonly used than documentary letters of credit. Quite often they're used to ensure payment. So it's not unusual for an exporter to ask an international buyer to put up a standby as collateral put up against their good faith on open account terms. So this can be used in many ways. The one caution for importers or buyers is the fact that if you put up a standby letter of credit, you can end up paying twice. So let me explain that. The way that can work is, let's say that you are an international buyer. You've put up a standby letter of credit, let's say for 90 days. So if you don't pay within 90 days, then they can collect on the standby letter of credit. Well, let's say for some reason you don't pay within 90 days. Let's say you pay within 91 days. You could risk that seller collecting that standby on day 90 and you issuing payment on day 91. So what that really leads to is the fact that if you're going to do this, this is a good mechanism, but as buyers you have to be careful that you're actually not paying twice. So you need to make sure that you understand what you've obligated to within that letter of credit. Another best practice is what's called bill discounting. Bill discounting is basically cashing or trading a bill of exchange at less than its par value and before its maturity date. The cash is realized varies according to the number of days until maturity and risk involved. So to explain how this works in plain English, bill discounting works on a letter of credit. Not any letter of credit, but what is called a usance letter of credit, spelled U-S-A-N-C-E. Basically, a usance letter of credit is a letter of credit with time terms built in. So let's say on a standard letter of credit, you as the exporter ship the goods. Your documents are within compliance of the letter of credit. The buyer's bank reviews those documents. At that point, they can then process payment to you. On a usance letter of credit, That letter of credit works the same way, but at the point at which the bank accepts that obligation and is ready to transmit payment, they don't have to do that for a number of days after that acceptance point. So you can build 30, 60, 90, you can go up to 180 days on a usance letter of credit. So the advantage to a usance letter of credit for an international exporter is that they can extend time terms to the international buyer, and rather than having the risk of extending open account terms, because they've established terms under a letter of credit, those terms are guaranteed. So in other words, if they perform, they know that they will get paid within a certain amount of days after acceptance. So it's a very good way of offering what it feels like open account terms, but mitigating or reducing their risk by using a letter of credit. Now the thing is, what if you do something like that? You use a usance letter of credit, but now that you want your money before, let's say, that 30, 60, or 90 days. Well, one way to do it is, on a letter of credit, one of the main documents when documents are submitted to a buyer's bank is what's called a draft. That draft, under a regular letter of credit, is paid once the bank accepts those documents. So in other words, the minute that those documents are accepted by the bank processes payment. The negotiable instrument is basically a draft, and that draft is sent by you, the exporter, and approved, or that obligation is accepted by the buyer's bank. So that particular instrument can be bought and sold by banks. Banks actually trade these notes. So if you had let's say a usance letter of credit with a draft that was 30, 60, or 90 days, you could actually go to your bank, the buyer's bank, or some other bank and ask to discount that draft to get your money immediately. So that's called bill discounting. And banks will buy these obligations and they will actually trade them on a market called the BA market. So to give you an example of what this looks like, I had a client several years ago that was doing medical devices. They were selling to a distributor in Japan. The distributor in Japan wanted time to pay, 120 days. We gave them the 120 days against what's called a usance letter of credit. As soon as the letter of credit was approved, we took the draft, that 120-day draft, and we sold it. We were getting paid in less than 1 week, while at the same time our customer was still getting their 120 days. This can be, if for the exporter that wants a letter of credit, this can be a great way of extending terms, reducing risk, while at the same time getting paid in accelerated fashion. So it's a great best practice. It's been around a long time. A lot of exporters don't realize the value of it. Another best practice is inspection-based financing. So there are types of financing where a lending entity will lend money based on an insurance policy. So some lenders will lend based on what we call contract frustration policies. But the one I'd like to speak to is an unusual kind of insurance called SCI, Specification Compliance Insurance. Basically, this is a hybrid of a marine policy. So a marine policy protects goods against loss or damage. But this particular SCI insurance not only protects against loss and damage, but it also protects against non-performance of a seller or cancellation of an order by a buyer. So this is a very interesting way of financing a transaction. There are lenders out there that will use this to protect their interests. In other words, if the lender knows that they're loaning money for you to fulfill a sale, and at the same time they know that their risk is protected if that sale, if some problems arise from the sale, then they're more likely to do the deal. So specification compliance insurance, if you look it up on the internet, you can find several different lenders and companies that offer it. But again, not a real common type of vehicle, but it's certainly a best practice, and I've seen it used, and it works very well and very effective. Another best practice is currency hedging. Currency hedging is basically using a mechanism of hedging to reduce your risk in offering a foreign currency amount for your exported item. So in other words, let's say that I'm a U.S. company and I'm doing an international transaction with Australia. The Australians want me to quote in Australian dollars rather than U.S. dollars. Well, the risk to me as the exporter is the fact that if that currency strengthens against my currency, then I'm going to get less money than I quoted. So doing these international transactions in foreign currencies is very tricky because there can be a movement of the currency that can go against you. So what currency hedging is basically doing is hedging against that risk. In other words, the way it would work is, let's say, going back to that transaction, I sell to an Australian company. Let's say the deal will be done in 90 days. And I go to my bank and I say, I need a quote for Australian dollars for a transaction that's going to happen in 90 days. What that bank will do is they will give you a conversion rate. That conversion rate is based on them 90 days later buying that obligation from you and converting it to a set amount in dollars. So it's a great way to reduce your risk while offering a foreign currency quote to your client. So very good best practice. Now, the downside to a transaction like this is the way currency hedging works is the bank will demand payment on the very day that they quote. So in other words, if you say that a transaction will complete in 90 days, then you owe the bank that amount of money, whatever you quoted, that you owe them that foreign currency in 90 days, not after, not before. So the problem with this is a lot of deals usually don't conclude on the day that you think they are. So let's take this 90-day example. If you had this 90-day Australian dollars transaction and the Australians didn't pay you till day 92, now you're in a position of having to buy currency to give to the bank to fulfill your obligation, then having to convert the currency at market rate all over again because you got paid 2 days later. So there's another best practice to protect against this, and it's called a forward contract, or to better describe it, a forward window contract for currency. So what that is it allows for a period of time of settlement within that currency. In other words, if I go to a bank and say, I would like a forward window hedge for 90 days in Australian dollars, what that means is that hedge, it'll be slightly higher rate that the bank will charge you, but it will give you a settlement period 30 days before or after when you think that transaction is going to settle. So in other words, if I have a 90-day transaction and I get a 90-day forward window hedge, I'm protected 30 days past the 90. So in other words, I can relax a little bit more about the settlement day and still have all the advantages of hedging. Now, the thing to remember about hedging is it's a way of reducing the risk if the currency moves against you. At the same time, it also decreases your opportunity for an advantage if the currency goes in your favor. So so as much as it protects you, it also prevents you from receiving the opportunity if the currency actually moves in your favor and you had the opportunity to make more money. So again, good best practice, but you have to use it with some amount of caution. The other best practice, and this is really where most companies derive their financing from, is supplier financing. you especially have to be conscious of this in international trade. If you're an international exporter, the majority of buyers that you'll encounter will want you to extend open account terms. In other words, they want you to take the risk on those open account terms of payment. The reason they want that is because chances are you're going to lend to them at a cheaper rate than what they can borrow in the foreign country. It's not unusual if you're a U.S. company, if you're selling to a foreign company, that their rates to borrow your foreign currency to pay you the U.S. currency might be in the double digits to do that kind of borrowing. Whereas if you take on the open account terms, there might be a huge savings for them. Likewise, if you're an importer, there can be a lot of savings in getting open account terms because that's that much less money you have to borrow from your bank to do the transaction. So given that, it's very important to cultivate your relationships with good suppliers. I often make the recommendation to importers that I work with is if you have a good supplier, cultivate that relationship. Don't always push for price adjustments because that may cut you out of the opportunity of getting good open account terms with them. So remember that your suppliers are very much stakeholders in your business if they're giving you open account terms. So there's many, many more best practices. I wanted to go over some of the main ones that influence international trade, and hope this was helpful for you, and talk to you next time.